Good morning, everyone. Thank you for joining us for this market update with Rhett Kessler and Anton, the portfolio managers of the Pengana Australian Equities Fund. My name is Adam Myers and I lead the distribution team at Pengana. 2 months ago, on March the 19th, Rhett provided a webinar fund update. That day, the ASX closed at 4737, 33% down from its close a month earlier. International markets had roughly moved in line, and the S&P Volatility Index, which is sometimes referred to as the Fear Index, had closed at 76 the previous night in the US. Since then, governments around the world have injected trillions of dollars into the system through a range of stimulus measures, and while the economic effects are still unknown, equity prices have rebounded strongly, and the VIX closed last night below 30%. Today, Rhett and Anton will provide their perspectives on the events of the last 2 months, focusing on how corporate Australia is coping and adjusting in these unprecedented times. During the presentation, if you have any questions, please enter them in the question box on the top right-hand corner of your screen, and we will get to as many of them as possible in Q&A at the end. Rhett, Anton, over to you.
Thank you very much, and thanks everybody for your time in attending. There's that wonderful phrase that says that there are, years when nothing happens, and then there are days when years happen. And certainly the last month has been the latter, where we've seen enormous changes and activity almost on an hourly, never mind daily basis. So Anton and I are going to talk a little bit about how active we've been, what we've seen, and what our observations are. And so if we move into the presentation, the first slide is essentially just a summation of our team. We're small, we're a focused team, we're all working remotely. I must say that, much to my chagrin, by getting out of the way of my analysts and working at home and allowing everybody to get on with what they're doing, it's working exceptionally well. We chat all the time, both over the telephone and on Microsoft Teams, and certainly our collaboration has never been stronger, and we're very excited about the new working arrangement, and it probably, if we're a microcosm of what's happening around corporate Australia, we've certainly shown that the tools are there to be able to work remotely. So a good experienced team, all quite resilient, and I've certainly been very impressed with the way the guys have responded to the challenges of investing in this environment. But enough about us, and maybe on to some of the observations. So if we go to the next slide, and the next one. Certainly what Anton and I hope to cover today is the journey that it's been in a very short period, in about 4 to 5 months. We've gone from exuberantly optimistic expectations to replaced by absolute fear and panic. FOMO certainly morphed into just straight fear. What probably has been a bit of a learning, even though we suspected that it was problematic, has been the range of market participant reactions. And we've seen some enormous institutions, and I include the ETFs because they're big players in this, react quite aggressively, and in many cases falling over. So when you shake the tree really hard, lots of things happen, and I'm including in this ETFs, hedge funds. We'll talk about each of these separately. The industry super funds, we have a very strong view on that, and we've even seen massive action by sovereign funds, particularly out of the Middle East, as they sold down enormous amounts of equities during March to fund what was essentially an oil price war. An easy way to think about what's going on is we've had, on a global basis, an attempt by governments to induce economic hibernation. And essentially what they're trying to do is they're attempting to build a bridge across a very deep valley that's been caused by the lockdowns. They're using the banks, they're using stimulus, they're using low interest rates and a range of factors to build this bridge. And as we're coming out at the other side of lockdown, the real question on everyone's minds is what has been the impact here. Now, first, can I say that this is very, very different to a normal recession for one reason, and that is that typically when you go into a recession, governments usually are in denial, because by reacting and saying we're in a recession, they would be essentially admitting that their policies have failed. And so you usually get a delayed reaction to going into a recession. This is completely different in one important respect, in that the stimulus has been provided before the recession's actually even hit, and it's governments have all stepped up and using tools that I don't think we've seen the concerted firepower. These have really important implications for the value of money post this, and we'll get to that in a sec, but that's one of the big implications. So I'm going to hand over to Anton now on the implications. I'll just mention that forecast risk is really high. It's off the charts, and so we've had to be very, very careful about trying to forecast the unforecastable is really a waste of effort to some extent. And so we've had to really rely on one of our core theses, which is the underlying power that various companies, due to their business models, and as Anton will talk about, their balance sheets have. So over to Anton.
Hi, good morning. Yeah, so as Rhett mentioned, forecast risk is off the charts. Most companies walked away from their guidance for FY20 and in some instances FY21, and that's really because of the uncertainty. So if you look at the different levels of lockdown as well, that also has a big impact on the forecast going forward. So we've done detailed work on the different levels of lockdown from 1, 2, 3 to 4 to see how our earnings might recover. But the more important point is that what happened here is that most of the companies has actually gone to just survival mode, and that's via the balance sheet. So all the companies that were in the position to actually raise capital, to get them through this valley, will become stronger. And the guys that can't raise capital, the smaller guys, will fall to the wayside. So a very good example of that is, for instance, Credit Corp. One of our holdings in the fund is they not only raise capital to actually survive this valley, but also to strengthen them and to actually take opportunities that might come up in the market, either way by buying cheaper or buying out competitors. Another example might be a company like Ramsay Health. There's also the similar thing. It's really to strengthen the balance sheet. So our view is really that after this, we might have fewer players, but much stronger players. This whole, COVID has also created a lot of opportunities for companies, and it's actually fast-tracked companies to innovate, or they were actually forced to innovate. So if you look at the big four banks, for instance, they've all accelerated their investment in digitization. This morning I read an article on Woolies where they've also accelerated just not online sales, but also where people can, buy scanless, not interact. So this is really for the strong companies and the companies that's actually pre-invested in this as well. It's stood them in good stead. Over to you, Rick.
Thank you. So really, essentially, what we're trying to say is that during this period, Anton and I went from Mr. Grumpy and Mr. Cranky at being frustrated about the lack of opportunities out there due to pricing, to incredibly enthusiastic. Yeah, we are a little bit twisted, but we like crises and we don't like wasting crises. And so we've put our money where our mouths are, and we've literally deployed between $80 and $100 million of our cash, both physical cash and by liquidating our insurance, into the market and into opportunities. And so what I thought we might do is just spend 20 seconds on what we think happened. And so if we go to the next slide, just to take you on the journey. Essentially, our view was that due to the weight of money at ever lower interest rates and the search for yield and returns and FOMO, there was a disconnect between the All Ords and fundamental value. And if we go to the next slide, you'll see that when COVID hit, not only was there a move back to the fundamental line, but because the fundamentals had rebased lower due to a less buoyant outlook, the market had to actually fall further. But in fact, it fell even further than that. And this is what I was referring to: when you shake the tree, funny things happen. And if you go to the next page, essentially there were, liquidity events. So we had margin calls, we had sovereign funds liquidating, we had hedge funds falling over, we had ETFs, liquidity issues getting raised, and massive downdrafts at the end of every day as ETFs or exchange traded funds liquidated their positions. And that's what created the panic in March. We were fortunate in that even though the portfolio was down, we had a lot of protection and we had a lot of cash. So we were able to keep our heads up and act from strength. If you go to the next page, then what we've seen is a real bounce across the board as fear and panic have turned back to FOMO, and we're really seeing in the market enormous activity as people try to take advantage and not get left behind. One thing that is a real implication at the moment is there's a trifecta of influences over the industry super fund industry that is really driving some pretty weird behavior. So industry super funds are the big gorillas in the Australian market. They have hundreds of billions of dollars under management. Typically, they have invested substantial amount in unlisted assets that haven't been revalued for some time. And what's happened now is that unlisted asset valuations have been rebased lower, simultaneous to the government allowing withdrawals, early withdrawals of $10,000 this side of June and just after June. And so the industry super fund actuaries have to predict what kind of outflows for the first time, in size they're going to be experiencing. And as you can imagine, if your unlisteds are mispriced and you have big outflows, that has serious legal implications for the people who leave and the people who stay behind in terms of the valuations. And so also the third part of the trifecta is that there are serious criminal implications for industry super funds trustees who don't get this right. And so we're seeing enormous rebalancing of these portfolios, and there isn't a day that doesn't go past that we don't get offered big lines of stock from these funds, and that's creating a bit of distortion, and hopefully we're taking advantage of that in the best possible way. If we go to the next slide, I'll just very quickly, when we approached this, we built up about 18% of cash, and we had our puts, which have been incredible investments, and then we had a careful selection of defensive stocks. I will highlight that there were two components to our portfolio that were really affected and had a very high negative impact on the portfolio, and that was the smaller financials and the discretionary retailers. Now, if we didn't have the first two pillars of our portfolio, I'm not sure we would have been able to withstand the pressure as everything sold off. But because the puts kept us whole and the cash allowed us to take advantage of opportunities, we were able to withstand this downward pressure and actually keep our heads up and look to make some serious money. So we go to the next slide. What we actually did was we selectively deployed cash across a wide range of existing portfolios, existing holdings. We crystallized our insurance at extreme levels. So the contracts cost us about, the put contracts cost us about $1.25 per contract. And as volatility went through the roof and the index fell, these puts morphed into futures, and they became worth enormous amounts individually. So from $1.25 they went up to, we sold our first tranche at about $9.50. We sold the second tranche at about $14, $15. And then very proud of the fact that one day when I was feeling really, really sort of panicky about the market, we managed to go the other way and sell quite a large tranche at about $20 a contract and bank those profits. We still have about a quarter left, and obviously that's hurt us in the bounce, but we think having that insurance is still a very good idea. So we've been taking advantage of new opportunities, and we've broken this up into two different categories. I'm going to ask Anton to talk about Rio, and then I'll talk about some of the others as well. So Anton, over to you.
Okay, so Rio Tinto is a new holding for us. It's just under 3% in a portfolio. So we invested in Rio many years ago, and the way we look at it is really, if you look at Rio, what are you buying? So at the end of the day, you're buying the iron ore business, which is about 80% of the valuation. Then you've got aluminium, 10%, and you've got other stuff, copper and diamonds, which is another 10%. So this is all about the iron ore, which is the world-class deposits and operations in the Pilbara. So the way we look at Rio is we actually reverse engineer and look at what in the current share price, what that implies on a spot price and on a FX. So we don't have to actually forecast what's going to happen with iron ore prices or FX. We just look what is implied in the share price. So if we look at the current share price of Rio Tinto, and you use a $60 per ton price for iron ore, you actually get a 10% yield on this company and a 6% dividend yield, and that compares to a $96 of spot price, so it's way below spot, which gives you that margin of safety. But then if you look at the cost curve of Rio Tinto, they're one of the three most efficient producers of iron ore. So the cheapest one actually is Fortescue, but you have to remember Fortescue gets a discount because they don't have the same quality of ore that they sell. And then it's Rio Tinto, BHP, and Vale, which is based in Brazil. So if you look at the cost of Rio, their C1 cost or their cash operating cost is $15 per ton. So compare that to a $96 spot price. If you add in, if you're even more conservative, and you add in all your overheads and all your capex, not just maintenance capex, you get to $20 per ton. So in essence, there's a $75 margin of safety, which is really for us, a good deal. If you look at the iron ore market in general, iron ore has actually been very strong the past 2 days, but and there's a few reasons there. So if you look at the supply demand, in Brazil, there's a few problems there on the supply side. Firstly, because of weather, and then secondly, because of COVID. As you know, COVID is not well controlled in Brazil. So Vale, which is the fourth biggest, exporter to China, is struggling to keep up with demand. We also thought that, China always, after a recession, they sort of, create stimulus, and obviously Rio Tinto and BHP, for that matter, is very well placed for that. And Rio also supplies, 50% of that is to China and Japan and Europe, although the recovery in Europe is a bit slower. So in essence, that's why we like Rio Tinto. It's got a very strong balance sheet. The debt they have, they can cover 4 times by the cash flow just out of the iron ore business. And then lastly, management has really proven themselves to be very disciplined in capital allocation, and they really run this business for cash. That was quite clear when we met with them as well. If you look at the iron ore business, it's got a 57% margin, and are really, are very conscious on how to allocate capital, not just on buying businesses or, but also on the way they maintain the, the operations with maintenance capital. So that, in a nutshell, is Rio Tinto. Yeah.
Well, thanks, Anton. That's well covered. So we want to stress that this was during March when stocks were on fire sales. We're going to get to how we actually chose them, but I wanted to give upfront the two different groups of new opportunities. This is on top of deploying enormous amounts of money into our existing holdings, but essentially Meridian and a small holding in Contact, which are both New Zealand gentailers. Ramsay Healthcare, we've got quite a story on that one, but happy to take any questions on it. James Hardy, the results just came out today, and we've been validated on that in spades. It's now about 25% higher than when we established that position. Again, this is one where indication we think that discretionary building materials company would not be the thing to buy as we go into lockdown. But this business has been remarkably resilient, even in the past GFC. So we really like this business. Happy to talk about that. Bapcor was also a very good pick by Chris. And this really set us up quite well to then participate in attractive capital raisings. The first one off the blocks was Cochlear, which we don't have on our list and we don't have in the portfolio. And we did have a big crack at it because for the first time, it looked like you could get it at a bargain price. But the company itself really stuck to corporate governance and didn't give any shares to any non-existing holders. And we think, although we were really disappointed we didn't get any, we think that's good corporate governance. But there was an absolute surplus of great opportunities to deploy cash. Credit Corp, we cornerstoned, got shares at $12.50. NAB was in the $14. Ramsay, because we were an existing shareholder, we were able to get a really good stake at $56. Likewise, Bapcor, Auckland Airport, and Flight Centre were all done at very, very attractive prices. And we'll take any questions on those. So if we go to the next slide, I'm just going to very quickly, I don't want to use up too much time, but we really refined our criteria for deploying cash into this unusual environment. And it's not that different from what we normally do, but we did add a couple of additional issues. One was we wanted liquidity, so we want to be able to change our minds because forecast risk is quite high. Second of all, we need survivability. So we need the balance sheets to be bulletproof as well as the business models. Thirdly, we want the businesses to emerge stronger because their competitors fall over. Anton's already mentioned Credit Corp. We think Aristocrat is another prime example of this. Their competitors are RGT and Scientific Games, very leveraged balance sheets. They've had to cut, and the other two have had to cut back on their R&D. And under pressure, Aristocrat's got a very strong balance sheet. We think they'll come out very strong out of this. We want to be able to buy them at bargain prices, and we think we've done this, and we think we've set up the portfolio for the next 10 years. And then lastly, and probably most interestingly, we're seeing a real bifurcation in the quality of the management, not just because they have to be competent and they have to be honest, but it takes a special kind of person to be able to go to war, not with your competitors or your regulators, etc., and the other people you interact with, but with the virus. You have to be able to make decisions quickly, and you have to be quite innovative and have a good team around you. And so we think we've positioned the portfolio well in that regard. Now, something that's, if we go to the next slide, something that's probably quite useful for everybody is just how we've approached the framework of working our way through this high forecast risk. And I'm going to share a couple of issues with you. So for every company that we invest in, we have an investment thesis and we have milestones against which we test that investment thesis to make sure we're on the right track. And so we built a similar framework for this unusual period. And we've established, importantly, we've established milestones against which we're measuring this. This is the way it plays out. Now, we're not going to give away all our secrets because some are still in formative stages in terms of the positions we're building, but I will give you a few. So in terms of the duration of the lockdowns, that is a key forecast, and the nature of the lockdowns, both in Australia, New Zealand, and obviously the States. And probably the best example of this would be, we think Australia's done a fantastic job. We think the politicians have really stepped up in this regard, and we think that they want to actually get some wins on the board. And so we worked out that the first area that would probably be unlocked would be the ban on elective surgeries. And that's really played out very, very well, both here in the UK and in Europe, where Ramsay has its operations. And this allowed us to take quite a big position in Ramsay when everyone thought that elective surgeries would be banned for a long time. And then the capital raising came, we built up an even bigger position and gave us the courage. And now they're gradually opening it. And we think there's a backlog of about 67,000 elective surgeries that will be done over the next few years. And so Ramsay will be operating at really attractive operating metrics, and that's only Australia. The same would go for the other countries. We then have to think carefully about the impact of the economy, and I've got a few slides on that, which I'll come to in a sec, and maybe I'll talk to them when I get to that. And lastly, which we've really exercised our minds on, is the changes to corporate and consumer behavior. You know, how long will international travel be away? How much will happen at home? How much will people be working at home rather than going into offices? To what extent will the digitization impact positively on omni-channel retailers? And we've taken some big positions there, and it's playing out pretty much as we expected. So this is a framework. Happy to take any questions on that. And then I thought lastly we might just share with you some of the charts that we stay on top of to give you a sense of the volatility. So, you know, trying to forecast what's going to happen to unemployment and utilization when you have charts like these, where they just move into unprecedented territory, is very, very difficult. Now, our view on this is the way it'll play out is that the government's trying to keep the economy alive by putting it into hibernation and really funding everything. And this is happening around the world. The real danger point for us is not the next 3 to 4 months. It's really all about what happens when in September, October, when JobSeeker, JobKeeper ends, the bank holidays on loans ends, and the money that people have pulled out of their pension funds, both this side and the early next year, runs out, right? And so we're thinking that we're going to have a W-shaped recovery. So we think things will really improve. Everyone wants a bit of retail therapy. We think new cars are going to explode because nobody wants to use public transport, and we've already seen inquiries go through the roof on new cars, and we think we're quite well positioned for that. And then we'll see sort of a bit of a hiccup in October, and we're planning for those kind of things. So bear with us on this. This is still a work in progress, but we think we've positioned the portfolio really well. If you go to the next slide, you know, obviously if you're in hospitality and you're in recreation where you involves large groups of people like sporting events, etc., life has not been great and probably won't be for some time. Right? It's going to be difficult. Domestic tourism will do really well. We think the bubble between Australia and New Zealand will be opened, and that'll be the first test of international. And so, you know, Auckland Airport positions us really well there. But essentially, those are really tough areas. Your toilet paper and toothpaste type stocks, which we sort of specialize in, are right at the top end, where you've had, you know, very, very stable, if not accelerated spending. If you go to the next slide, this is really brought out by, you know, your retail sales data to March. You can see pharmaceuticals, food retailing, which includes obviously toilet paper and toothpaste, right in there. And then you've seen a real fall off in clothing, footwear, cafe, restaurants. I don't think I'm telling you anything new. Admittedly, this is to the end of March. April saw more of it, and then we think May and certainly June will see a rebound in lots of things. Next slide, please. You know, we've looked much broader. We've looked in the States, and there's a really nice chart in terms of, you know, who's doing well and who's doing not so well. And I think this is pretty well known, but I just want to give you a sense of how we're looking at it. If you look at the last page on this area, it's just another sheet. And so obviously our Woolworths, our utilities, you know, the kind of toilet paper and toothpaste type stocks have done quite well. I'm just conscious of the time, so I'm going to go on to the next slide. There's a quick look we've included in the pack that you'll get, just how we think about Rio. I think Anton covered it excellently. And then maybe on to the next slide, which is just a shape of our portfolio. There are a couple of things I want to point out here. First of all, we have never ever been big investors in things like gold mining or Rio or iron ore mining. I want to stress that for the first time, we really have been thinking quite hard about what is a dollar in any currency we're going to be worth with everyone's stimulus and printing, money printing machines turned on at full blast around the world. And so our focus has been on hard assets. And we think a gold factory like Evolution Mining, the lowest cost producer with a squeaky clean balance sheet like Rio, Viva REIT, those kind of businesses are going to really hold us in good stead. And obviously the very high IP with pricing power companies like CSL and ResMed will do exceptionally well. The other point I want to make is I don't think any of you have ever seen our cash levels this low at 5.9%. So we certainly have put our money where our mouths is. We've certainly reached across the abyss and deployed a lot of money, and being quite excited about doing it. We're not, betting the bank because we still have the insurance, which gives us protection against about 8% of the portfolio. So we're really at about 87% invested. But we think that the shape of the portfolio will stand us in very good stead. We're very excited that our after-tax cash earnings yield is still up at about 8.1%. That's a very high number. I suspect it's come down a little bit during this month. This is as at April, because we've had quite a reasonable month. So Adam, and I might pause there and throw it open to questions, and I'll take any. I think we've still got another 10 to 12 minutes or 15 minutes for questions.
Thank you. Thanks, Rhett. That was great. So we do have a number of questions. I will try and organize them roughly into categories so they make more sense. They flow better that way. First question is on the Australian banks. What is your outlook in terms of profits, dividend flows, and share capital growth over the next 1 to 2 years, and particularly based on expectations of bad debt potential growth?
Yeah, so this is something we spend quite a bit of time on. We have approximately 10% of our portfolio in banks, which for us is quite a big bet. So you can take it from that we have a reasonably positive view. Our most recent large expenditure has been into NAB, in that capital raising, and that's our biggest single holding in the banks. We have a very strong view that if you buy one of the essential planks of the recovery for Australia, which is the big 4 banks as they try to build that bridge across the valley, and if you can buy them at 75 cents in the dollar, which is quite unique for buying Australian banks, that's not a bad deal. The banks are well capitalized, have conservatively positioned themselves on their credit risk, and have taken quite enormous provisions. We think there will be larger bad debts than there have been in the past, but we think they will be manageable. Otherwise we wouldn't be there. We know that a year or 2 out there will be an impact on bad debts and therefore earnings, but we think that when we're buying it on a sub 10 multiple at a serious discount price to book value, they represent good deals. We're not expecting any fireworks in terms of dividends or in terms of earnings for the next year or maybe even 18 months, but we do expect that after that the banks will be in an even stronger position to monetize their dominant position in Australia, and we think they're attractively priced for that. Anton, I'm not sure if you have anything to add to that.
No, not really. No, it's well covered. Thanks.
Okay. Next question, please.
Thanks,
Adam.
We've actually had a number of questions along this theme. Can you comment on why you prefer Rio to BHP?
Okay,
I'll give a simple. Yeah. Okay, you go, Anton.
Well, Rio Tinto is just a much simpler model for us to, to get our heads around, and the fact that, the growth really is in iron ore. So if we look at BHP, iron ore is a much smaller component. It's about 45% of the total earnings, whereas in Rio Tinto it's 80%. So I don't have to worry about, the oil price. There's lots of other moving parts in BHP. But having said that, BHP is a well-run company. It's a good company. It's just Rio Tinto is more attractive to us.
Great, thank you, Anton. Rhett, anything to add?
Yeah, I just want to stress with everybody that our job is not to try and invest in every company and find every winner. Our job is to try and find enough companies so that we can achieve our goal of capital preservation and risk-free rate plus 6% or better, and then we're certainly targeting that. So where we're not sure, we tend to not play.
Great. You mentioned missing out on Cochlear. Are there other capital raisings that you would have liked to participate in, but you couldn't get set?
Yes and no. We've been reasonably happy with our access to capital raisings. Cochlear was just a clear standout. We did put up our hands for Oil Search, which we thought was very attractively priced. It took away a lot of the risk, but there again, management focused on the existing shareholders. And probably lastly, a very probably not most of you have never heard of the company before, but Vista in New Zealand, we tried to get some, and because we weren't a shareholder, we didn't. But that was much smaller. So those are probably the best examples. It's been fluid. There've been about 60 capital raisings. There have been so many opportunities that we've really focused where we can get bang for our buck.
Okay, great. And sticking with the same theme, an unprecedented number of companies have raised capital in the last few months. This person's asking you to generalize here, but do you think that those balance sheets have been sufficiently shored up, or do you think that danger may still lurk ahead for some of the companies that have raised capital?
Yeah, I mean, that's a very broad question because, there have been about 60 companies that have raised capital. So that'll probably be true for some and not true for others. Can I just say that the pitch by the investment banks, whose job it is to make fees by getting companies to raise money, has been that there's never been a disconnect between the uncertainty looking forward for your business and the propensity or willingness of fund managers to throw money at you. And so when wallets are open, you should go hard, particularly given the uncertainty. And many companies have embraced that. We tend to focus on the areas that we know and understand well. So we think that companies like Credit Corp, Ramsey, NAB have certainly bulletproofed their balance sheets to the extent that survivability is a fait accompli. Obviously, something really weird could still happen. So I'm not you'll never be 100% sure, but we think that has taken the survivability issue off the table, and that's why you've seen a big re-rating in the companies off those levels. As the fear and uncertainty starts to ebb, which is certainly happening, the ability of management then to deploy their superior and more powerful position by making their strong get stronger and making themselves the stronger ones is certainly playing out as we predicted, particularly in those three companies. I don't really want to go broader than that.
Perfect. And here's a question from one of our New Zealand clients. Can you tell us how you value the Auckland airport?
Well, I'll throw that one to Anton.
Well, the Auckland airport, we do own a sum of the parts business, so about 50% of it is a regulated income, and then you've got retail and you've got property. So we used really FY19 as a yardstick to value that, because obviously for the next 12 to 18 months, earnings are really going to be depressed. But the price to book value is also much more attractive than what it was. Just to come back to that previous question on, when we raised capital on the survivability. So in Auckland Airport, if you look at the current cash burn, they've got 21 months of leeway where they don't have to earn anything. So in Auckland Airport, we've actually done quite a bit of work. If you look at the forecast risk as well, which we talked about before. So if you look at broad-based. You've got the 4 lockdown levels in New Zealand. So at alert level 3 and 4, you'll be EBITDA break even. At alert level 2, you'll sort of make a small profit, but at alert level 1, you'll make about 70% of the profits that you made in FY19. And as Rhett has also alluded to before, the big driver of that will be obviously domestic travel within New Zealand, but also the trans-Tasman bubble. Whereas if you look at the international travel, 50% of that travel is between Australia and New Zealand. So yeah, we think there's a good probability of earnings to recover, and this to us is a longer term FY22, where we'll get back to sort of normal levels again.
Thank you, Anton. The next question is also clearly from an investor who's heard you talk before, because this question is about the uncertainty associated with the cost of money and the impact on asset valuations. Global stimulus has obviously distorted this further, so how are you factoring this into your thinking?
Yeah, so that is probably the number one thing on our minds. And remember that when we're investing, we're trying to create or maintain financial independence. And the best way sort of to distill that into your day-to-day thinking is to say that how do we ensure that our purchasing power remains constant of the value of the money that we manage. Sorry, not just constant, but obviously growing. And so trying to find businesses that are able to keep up with the demonetization of currencies, or there's another word for it, is inflation, but with everything being so deflationary at the moment, it feels silly even saying inflationary. But at the end of the day, if there's 50 millennials running around with the extra $750 a week that they get, and they're all chasing after the same tube of toothpaste or roll of toilet paper or drink at a bar, and you can't make more toilet paper, you can't make more of the drinks, the price of those drinks just has to go up, and that money becomes worth less. And that's essentially, I guess, the question you're asking that I've just paraphrased into a different concept. So what will hold its value? And we think gold will hold its value in this unusual time, because the cost of gold producing gold remains consistent and might actually go up. So therefore, gold should hold its value, and that's the thesis. Iron ore is a hard asset. If we can find stocks like Viva REIT, or it's now called Waypoint REIT, it's a real estate investment trust that owns owns all the Shell petrol stations as the landlord on triple net leases. You can buy it on a 7% yield and a 3% increment every year, and essentially Coles is your tenant, and you've got 11 years lease still to run with a 3% increase every year on your rent, starting at 7%. We think that's a hard asset, right? And so we go through every business. If you've got pricing power, so if your costs go up and you can pass on those costs through to your customers, then and you're already the lowest cost producer, then that provides some support to your purchasing power. But it is non-trivial. I will say this is one of the hardest things we're wrestling with, is how to preserve it. And I think that's why there's a rush to equities, to be fair, is that we don't think fixed interest or keeping your money in the bank is going to protect you against that. It may protect you and will protect you against short-term devaluation of assets and different asset classes, but it won't protect you over the medium term in terms of your purchasing power. And that's the benefit from being with a boutique like us, where we're constantly thinking, because all our own money's in it and our mandate is attuned to this, and we're constantly thinking about how to protect the value of your money rather than trying to beat the market.
Sticking with big picture, there is a question here about the potential that deflation may be a significant risk as well. Do you have any thoughts on that?
Yeah, I mean, never been a bigger sort of tipping point between inflation and deflation, and certainly with rents, with labor costs, with the price of oil and therefore petrol. You know, all the signs point to deflation. However, the sheer metrics of what happens when you stimulate points to exactly the opposite direction. And this is the conundrum, right? That we struggle with. And so, once again, if I can say that we try to build a balanced portfolio that takes advantage of both those sides, probably ends up somewhere in the middle. But this is exactly what we're wrestling with. And so I don't have a simple answer, Anton. Maybe you do, but every day we try to find investments that acknowledge both of those. And we think, as I've mentioned before, companies that are already the lowest cost producers, that have power over their stakeholders, and we can buy at a decent after-tax cash earnings yield, represent the best way for dealing with both of those.
Anton, do you have anything to add to that?
Yeah.
Perfect. Another question regarding the portfolio. Can you expand on the additions to your e-commerce retailers?
Yeah, so not sure what they mean by expand on our additions, but essentially our view is that we have that discretionary retail has, well, all retail now is omni-channel. So what I mean by that is you can't be, it's not enough to be a pure online retailer or a pure bricks and mortar retailer. You need to be present in every facet of the way your customers reach you. So I think the customer's fairly agnostic. There'll be some things that they want to go and try on a pair of shoes. They want to touch it and feel it. And the other times when they're comfortable just getting it via online. And if you can, the best way to service that market, in most cases, not in all cases, but in most cases, would be to be omni-channel. And so we've looked for the best retailers that are addressing these functions and positioning themselves well. And so we think Accent, one which dominates the shoe market in Australia. We think JB Hi-Fi, which is certainly one of the better retailers generally, but also dominates the much sought after electronics. And we think Super Retail, which is essentially Rebel and Super Auto, both very high quality brands that are growing their online sales. And Woolworths are well positioned. So I'm not quite sure by the question about additions, but certainly we're well positioned there and we're well represented there.
Thanks, Rhett. The next question is, do you think much about balancing value and growth in your portfolio, or is your process entirely different such that those aren't really considerations?
Anton, I might have a quick go at that and then throw it to you if you want. So we are completely agnostic. We don't mind if we can buy something that generates 10% after-tax cash earnings yield now, and will retain that for a long time, which would be designated to most people as value. That's okay with us. And if we can buy something on a 6% after-tax cash earnings yield, growing to 10% in 4 to 5 years with a high degree of certainty, that's also okay, and that's designated growth. So no, we don't really care about either one or the other, but we do understand that you want to be balanced, and that's the approach we've adopted. Sorry, Anton, over to you. Maybe if you've got something to add.
Yeah, we don't, as Rhett said, really look at it as value versus growth. I mean, our process has been consistent for 12 years now. And as Rhett said, it's really after tax yield. You get different starting points, but we don't classify it as, because there's a danger if you classify it like that. You tend to overweight certain stocks and underweight others. So we're agnostic to it.
Thanks, Anton. Next question, with the differential in pricing between listed and unlisted infrastructure, is there an opportunity, an arbitrage opportunity in listed, or will unlisted catch up?
Yeah, that's a great question. Yeah, I mean, I suppose that's a very broad question, but you're right. I mean, essentially, logic tells you that unlisted will probably come down to meet listed. More than listed will move up, and we're certainly finding that out now. Yeah, I mean, Macquarie Bank sold some infrastructure stocks to industry super funds that are currently being repriced. So yeah, I think it'll sort of merge over time.
Great, thank you. And I've got a couple of questions here, which I'll maybe touch on. I think that you have broadly covered them in your presentation, but maybe you can just touch on your views for markets retesting lows, how stocks will survive if there is a double dip, the opportunities that may present, etc.
Yeah, we spent a lot of time thinking about that as a macro issue. We've been surprised by the resurgence in the overall market. I suppose the fact that we're keeping our part of our insurance in place means that we're still concerned about it happening. And as we keep saying, forecast risk is incredibly high. Our worst nightmare would be a massive flare-up in infections, either domestically or in some of the other countries where things do seem to be getting under control. But our portfolio is not positioned to take advantage of a wholesale lift in markets. Our portfolio is positioned to take advantage of what we see as mispricings on the fundamental underlying values of the companies that will be survivors through this. And we're incredibly excited about the assets we've managed to accumulate at these sensational prices. So hopefully that answers the question. I can't predict the short-term movements. I don't know, Anton, if you want to have a go, but
no, we don't predict that. I think it's a really important point. It's all company specific, and it's not a top-down view of what's going to happen to the market.
Great, thank you. And one last question, and then we'll wind it up. Can you comment on the role of dividend yields as a component of total expected returns from your investments?
Yeah, I mean, look, dividends are indicative of underlying cash flows, real fundamental cash flows. They're not definitive. And so we expect that over the next period, dividends will make up a much smaller component because everyone's in survival mode and making sure that even if they are doing incredibly well, they don't want to attract undue attention. And so examples of that would be, for instance, health insurance. Their problem is, will they be able to I mean, they're making so much money this year because people can't claim, but people will go back to medical procedures next year. So their biggest non-trivial issue is how do they provide in the balance sheet for what will be a big lift in payouts next year, and they don't want to go into next year bare, so they want to hang on to that money. So I think dividends will be low as a component of future returns, but should accelerate if we emerge from this okay. And so I don't know if you agree with us, but I suspect that 2 years from now, dividends will be exceptionally fruitful as companies release their overly conservative balance sheets.
Yeah, I agree on that. Yeah, and companies will become much more efficient as well. So there's more to release.
I think in the interest of time, I'm going to wind up Q&A now. Thank you everyone for joining us for this market update today. I hadn't seen the presentation before, and I expect I wasn't the only one who found it fascinating. My key takeaway is that while risk remains elevated, there are very attractive opportunities for astute stock pickers. If we didn't get to your question this morning, we'll respond to you directly. And if you have any other questions, please get in touch. We'd love to hear from you. Thank you very much.
Thanks, guys. Thanks for your time.
Thank you.